Hello, good morning to all, and welcome to today's Daily Dose of Market Insights. I'm Kelvin Wong here, the Senior Market Analyst of OANDA Asia Pacific. Welcome back after yesterday's break. So today will be Thursday, 11th of April 2024. So before we start our Daily Dose of Market Insights, let's take a look at the disclaimer first. Pretty quickly, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so before we jump straight into the short-term technical outlook on the various broad-based cross-asset classes ranging from the major stock indices, the major FX pairs, gold, XAU/USD, and as well as West Texas crude oil, WTI crude. Let's have a recap of what has taken shape yesterday in terms of economic data releases, events, and as well as their impact on the major cross-asset classes. So for sure that before we went our Singapore public holiday break yesterday, we highlighted that things to look out for will be the US CPI data. And I also did highlight over here is that there's actually a risk of the US CPI data getting potentially moving to a uptick basis. Why? Because of because of commodity prices that tends to have a leading impact on inflationary trends. So later I'll touch on more about that intermarket relationship on how do we use market-based transacted asset classes in relationship with fundamental data. So this could give us a bit of leading element or head start on how to actually position ourselves in such a scenario. All right, so now let us take a look at the raw fundamental data first. All right, so if you look at the CPI data yesterday came in above expectation. So let's take a look at the data. All right, so let me expand my screen so that you guys could see much clearer. Okay, CPI data. Okay, so this is the CPI data that was released yesterday. So from a month-on-month perspective and a year-on-year perspective, for the core rate, so core if it's excluding energy and food, so the month-on-month actually came in slightly higher, 0.4%, month-on-month above 0.3%. That is what market is expecting, and also 0.4% that was being recorded in the previous month for February. So very similar for the core inflation rate as well, above 3.7% year on year, above 3.7% year on year. That was actually being priced in as a consensus. Came in at 3.8% for March, very similar rate to 3.8% in February. So even though you look at the core rate, right, it seems to us that it's actually flat. Okay, if you look at the case, seem to be flattish, but however, inside the core component CPI data, if I take out the services number or the services component by looking at it over here, services inflation. So if you look at services inflation has indeed rose pretty strongly, so at 5.36% year on year. So this is the highest rate since August last year. And if you put in the trend, okay, it's actually bottoming up, what you could see over here after that deceleration that took shape in March last year, and it starts to bottom up. So if you look at this situation over here, is that services side of the story tends to actually pick up, and if this pickup going to accelerate into the second half of this year, very likely the core CPI number, the core one that we may talk. Okay, let me share with you again. Where is the core CPI chart? Yeah, this is the one. Okay, whoops, sorry. Okay, let me push back the number. Yeah, this one. Okay, so there is actually a high chance that this core CPI rate also starts to slowly tick up as well. Okay, even though it's now flattish in the last 3 months or so. All right, so that being said, over here is that market is getting really pretty much jittery about this ongoing Fed dovish pivot narrative that I've been highlighting since the start of this week. That this narrative is there is a risk that this narrative is being overpriced or mispriced. What I mean by mispriced, that means market is expecting the Fed to actually enact or introduce its first interest rate cut this year. Initially, at the start of this year, market is looking at 6 interest rate cuts to be priced in by the Fed funds interest rate market, futures market, pardon me, as obtained from the CME FedWatch Tool, which has been showing on since the start of this daily dose 1.5 years ago. How to obtain that? I think most of you follow my daily dose, which might pretty much clear about how to obtain such expectation. Later, I'll flash again. So this expectation previously was being priced at 6 interest rate cut at the start of this year, and as new data starts to come in and latest Federal Reserve officials speech or guidance, it has been watered down from 3, and right now after yesterday it's been being increasingly priced only 2 interest rate cut for 2024. And what's interesting over here is that the first interest rate cut has been continually being pushed down the road. All right, initially it was being pushed in March to June and July, and right now it's not even in July, it's somewhere around in September. All right, so let me share with you the latest CME FedWatch we call it expectation. Right, so you guys could just Google CME FedWatch Tool. So this gives us the current market expectation that is being priced by the Fed funds interest rate futures market. Okay, just give it a bit of time, it's a bit slow running. Okay, here we go. Okay, so if you were to look at my screen over here, okay, so previously before the right after the March last month FOMC meeting, previously there was actually a high odds being priced for the first rate cut to come in June. All right, so right now the current rate of, okay, let me expand so that you guys could see much clearer. Okay, so I hope that this is large enough on your screen. Okay, 5.25%, 5.5%, this is the current rate of the Fed funds rate. Right now, after yesterday's CPI data, only 18% chance of a rate cut. Okay, previously around a week ago it was 62%. So notice the huge reduction in the probability. And let's look at July over here. So in a month, okay, so these are future FOMC meeting is being fixed already on the calendar. So the next one, 31st of July. So 31st of July, right, we're only looking at 6%. Okay, 38%. Only a 38, close to about 38% chance of a cut. So it's less than 50%. All right. So if I were to actually save down by not clicking in individual one of them, I could actually click on this chart called probabilities. So this probability gives us a snapshot of an aggregate picture. All right. So if I were to immediately flash my screen now. Okay, this one is the total aggregate probability. So they actually classify to us very clearly according to the columns is no change and high. And these are the various meeting dates that are fixed. Okay, this is American date. So the first one you see over here is month, not day. All right, so March the 1st, only 5% chance of the east. 12th of June, 19% chance. July, 31st July, only 45% chance as has been reduced. And right now, the first interest rate cut is being pushed forward to 18th of September. All right, 18th of September, okay, at 68%. Okay, so I hope that this is pretty much clear. And if you want to see how many interest rates being priced in 2024, you can look at the top of this table by looking at the light blue box over here as you push it diagonally down. So currently it's 5.25%. So you don't count this as one, okay, because it's the same. So the next one is 5% to 5.25%. If you do it diagonally down over here, so first expectation somewhere around in 18th of September, okay, then after that followed by November, there's nothing, there's no blue box here. The next blue box diagonally came in 18th of December. So what we could see over here is that that initial 6 interest rate cuts at the start of the year has been greatly reduced to only 2 interest rate cuts. And these 2 interest rate cuts projection, as indicated by this latest CME FedWatch Tool, data being obtained from the Fed funds interest rate futures market is much lesser, 1 interest rate cut lesser by the latest dot plot, median dot plot projection that is being projected by the Federal Reserve officials in the last meeting in March, where they still pencil in 3 interest rate cut for 2024. And potentially, if commodity prices continue to rise, these 3 interest rate cut projected by the Fed may get reduced in the June meeting, because let me share with you very quickly which particular meeting they do release the dot plot. So this dot plot is actually their Federal Reserve official median projection on the future Fed funds rate. Okay, so they don't release the dot plot in every Fed fund meeting, it's only every 3 months. So the next one will be very likely in June. So how to find out? Just very simple, just go to the US Federal Reserve where the hell? Okay, Federal Reserve website. Okay, so just go to the calendar. This is the calendar. So 2024 FOMC meeting. So take a look at that one, that particular date that has the little star behind. So let me enlarge so that you guys could see. So that you guys can see there's a little star behind here. Star means that it will release the monetary policy outcome together with dot plot release. So the next star will be in over here. There's an asterisk over here. Is in the June meeting. All right. So pay close attention to the June meeting. So if oil price going to be rather sticky at around this 85 to, and perhaps in the next few weeks time, if it start to accelerate to about $90 per barrel, there's a big risk that in the June FOMC meeting over here, where it will release the next dot plot, the Federal Reserve official may reduce the 3 interest rate cut to perhaps only 2, as what's being priced by the market. And why do I say that we need to watch commodity pricing rather than the CPI inflationary trend? Because CPI inflationary trend is lagging. So let me flash to you this chart again. So this chart, I believe that I flashed at the start of this week. All right. So over here, at the bottom is your CPI data. So this is no longer factored. So this data latest over here is 3.8 as well. This is 3.5. Let me quickly adjust it. Okay. So now the March one. Okay. So the core one is 3.8. Good. All right. So at the bottom at the top of this chart over here, right, this is what I call you can actually track it on you can track it on trading view. Okay, trading view, you are able to obtain this huge database of data that is listed on the New York Stock Exchange called Invesco DB Commodity Index Tracking Fund, DBC. So this DBC eventually is track the entire commodity markets, futures market. So they put it all the futures market, be it energy futures market, agriculture futures market, they bundle it together and call it ETF. They call it DBC in short. Okay, so the highest weightage, about 56%, is related to energy ETF. So that actually gives rise why oil price is very important. All right, so later I'll open a chart why oil price is important. So if you look at the trend of this DBC, for sure there's a bullish descending wedge breakout, and at the start of February this year, it formed a double bottom. All right, double bottom. Okay, so if you start to see a breakout of this resistance over here, okay, which is very close to the neckline, okay, I will use this higher, it could start to see another start of a potential multi-month uptrend, very perhaps similar to this previously, all right, in August 2021 to April 2022. Okay, potentially, if this 29.36 resistance is being taken out, but for sure, from a technical analysis perspective, is indeed a bullish, potential major bullish configuration that is forming in the commodities market by looking at the DBC price action. And how does it relate to the CPI data? So if you look at previously, when the DBC rallied from a multi-month perspective, that means evolving in a major uptrend phase, the core CPI and the headline CPI both accelerated as well. All right. So right now, the DBC is basing, and the core CPI data and the headline CPI data is not falling down. It's in fact pretty much flattish. So if we were to actually look at a price action perspective, if the DBC going to rally up higher, which has a leading element or leading price behavior, as look at the past price action that I explained earlier, potentially our CPI data and the core CPI in US and the headline CPI in US potentially could face upside pressure as well into the second half of this year. All right, so how does it impact market pricing? Other market asset classes, for sure, the US 10-year Treasury yield rose. Okay, so if you look at the US 10-year Treasury yield over here, okay, US 10-year Treasury yield rose. Okay, it rallied up highly, now attempting to break that 4.5% major resistance zone, the upper limit level over here. So if it starts to break up this 4.5%, potentially the next major resistance to watch out for is 5.2% as it continues to evolve in this major uptrend phase. All right, that is intact since the low of March 2020. All right, March 2020. So if we start to see a continuation of the up move in the US 10-year Treasury yield, so what it means that over here, that could be a risk of cost of funding getting higher in a environment where inflation rate remains sticky. And given that the Fed is now being boxed in a circle or in a box that they can't actually introduce interest rate cut cycle as aggressively as being initially anticipated at the start of this year, that could actually also reduce the demand side from the demand equation from the macroeconomic perspective. So with lower demand due to the lack of clarity in the interest rate cut cycle, it could actually potentially a reduced net profit margin of corporation, given coupled with the increased cost of funding as well. So that actually explains why the major US stock indices fell as expected. So those who actually recall our daily dose of market insight, even I went on leave, we actually flipped back to a bearish bias on the major US stock indices because I shared earlier on there's this intermarket weakness that is coming into the picture as well. So yesterday actually solidified this technical analysis trend, short-term trend, a bearish trend of the US major stock indices. So the major US stock indices all ended in the red yesterday. SPX negative 0.95%, the Nasdaq down negative 0.9%, very similar to the SPX. The Dow Jones Industrial Average fared slightly weaker, down negative 1.10%, and the worst hit was the Russell 2000, down negative 2.5%. So bear in mind that the Russell 2000 is company which has a higher level of debt burden as compared to the company in the SPX or the Nasdaq 100. So that actually explains why a strong uptick in the US 10-year Treasury yield have a much more higher adverse impact on the Russell 2000. And also with the rise of the US 10-year Treasury yield, the US dollar also rises as well. So the dollar actually yesterday broke above the sideways range resistance. So the sideways range resistance was 104.90. So it broke above yesterday and closed above this level over here. And yesterday's we call it daily gain of 1.04% is the highest daily gain since almost a year ago, which is at 7 March 2023. All right, so that is also a significant up move in the US dollar. So going forward, we may also start to see this kind of multi-week to multi-month dollar strength coming back into the picture. Also dollar strength, if dollar strength is getting strong, traditionally it also doesn't bode well for risk asset as well, like example global equities in general. All right, so that is the intermarket linkage. So I talk a bit more this time around because I want you guys to understand how does yesterday's significant movement impact the various cross asset classes from an intermarket perspective that I share with you, how I chart commodity market-based transacted commodity together with fundamental data. Now, other data that has been released at the before the start of our daily dose this morning will be China CPI data. Okay, let me share with you. Okay, so today will be Thursday. So China CPI data was released earlier today at 9:30 a.m. Singapore time. So China continue to be in a risk of deflationary risk spiral. Why? Because if you look at the inflation rate year on year for March, it actually went down negative, not negative, 0.1%, way below expectation of 0.4%, and below previous month, February, of 0.7% year-on-year print. And also, if you look at the PPI, which is factory gate prices, i.e., look at it as a cost of goods for manufacturers, no change, negative 2.8% year-on-year, slight downtick from negative 2.7% year-on-year from previous month of February, not April, pardon me, February, and almost came in line with market expectation, or in line with market expectation of negative 2.8%. So if you look at the year-on-year trend, right, it's pretty much a shape where the Chinese economy, okay, so you look at the 5-year trend, okay, it seems to be that it's still in a major downtrend, deflationary downtrend. All right, and if you look at the PPI data trend, all right, okay, this inflation rate, where's PPI? Yeah, this PPI. Okay, so if you look at the 5-year, okay, it has been below 0% line since around September 2022. Okay, so coming close to about 1.5 year plus or so, below the 0%. So what we could see over here is that the latest data from China, looking at the CPI and the PPI perspective, the deflationary risk spiral in China is still pretty much intact. So in order to actually meet that 5% growth target that the China top policymakers has already been penciled in at the in last month 2 session, they got to actually do it from an external economy. That means why? Because CPI data is weak. That means it tells us that consumer confidence and business confidence is not there to pick up that spending or that corporate investment to actually allow the China GDP target to be met at a 5% target this year. So the only way is to external economy, how? By reducing the Chinese yuan. So there's actually a big risk that the China authorities may use the FX market to actually boost GDP growth or juice up GDP growth instead. So with a weaker yen, stronger dollar, that could actually create another round of currency war as well from a medium-term perspective. All right. So a currency war also doesn't bode well for risk assets like equity from a medium-term perspective. So that's more of a medium-term time horizon. All right. So with that, I kind of concluded the fundamental and intermarket relationship from a medium-term perspective. So now on the shorter-term perspective, now let us straight away jump to the short-term technical outlook. All right. So let us start with the major stock indices first. All right. So major stock indices, the Hong Kong 33. Okay, let me expand my screen so that you guys could see. Okay, good. So for the Hong Kong 33, right, it seems to us that it's been trapped in a sideways range for the past 2 weeks. So yes, price action on before the CPI data did spike up. I mean, yesterday's Asia session while we are on a public holiday, but it can't break above the previous minor swing high area of 13th of March, and as well as the pullback resistance of this former ascending channel support that has been taken out. Okay, that I drew from the low of 22nd of January. It hit, tested one time, then it did that negative reaction of it. So it seems to us that the Hong Kong 33 right now in a shorter term perspective is being trapped like a sideways range. So with that, I will flip to a neutral base bias for today for short term. Neutral between 17,230 for sure, and as well as the lower limit of the neutrality range will be close to the 20-day moving average, which is also slightly above today's current intraday low, 16,650. So neutral between 17,230 and 16,650. Nikkei 225 or the Japan 225. So it actually reacted off exactly right at the minor descending channel resistance, which is the upper limit that I drew from the high of 27th of March, reacted off from here, the sell off, and hit the first support before bouncing off during today's Asia session as well. So given the fact that of yesterday's negative price reaction of the minor descending channel resistance, I will actually have a tightened key short-term pivotal resistance for today. We also confluence with the 20-day moving average, I think as a resistance as well, 39,810. So as long as this tightened 39,810 short-term pivotal resistance holds, we will still maintain that short-term bearish bias on the Japan 225, i.e. Nikkei 225. First support level to watch for sure will be the 39,070 that managed to survive yesterday. A break below 39,070 exposes last week swing low area at 38,770. Only an hourly close above 39,810 level will kind of invalidate this short-term bearish bias on the Japan 225 to potentially see a squeeze up for the next intermediate resistance to come in at 40,260. Above it exposes 40,760 next. Then German 30, one of the major European currencies. So German 30 continue to actually involve within this minor descending channel that I drew. So yesterday is as well, it actually hit the first support level, 80,050, before bouncing off, and right now it's actually trade below the 20-day moving average. So with that, I will actually use a tighten key short-term pivotal resistance for today for the German 30, 18,310 as my short-term pivotal resistance. We also correspond to yesterday's minor swing high that triggered that steep sell-off or the steep negative reaction. So as long as 18,310 is not surpassed to the upside, maintain that short-term bearish bias on the German 30 index, i.e. DAX. A break below 80,050 exposes the next near-term support level at 17,900, which correspond to the minor swing low area of 15th of March, and as well as the lower limit of this minor descending channel as well. Only hourly close above 18,310 invalidate this short-term bearish bias to potentially see a squeeze up for the next intermediate resistance to come in at 18,485. Above it, retest or exposes the current all-time high area at 18,650. Dow Jones Industrial Average, which is one of the major US indices that we monitor, continue to actually plunge lower and hit the first support level at 38,450 before trading sideways around this level. Okay, so let me push up. Okay, so levels be hit. So with that, the US Wall Street 30, i.e. Dow Jones Industrial Average, has really clearly broken below the 20 and the 50-day moving average. So bearing in mind these are daily moving average, how could we do it? Because on TradingView, we are able to plot higher time frame technical elements on a lower time frame chart. So like what I did over here, I show the hourly price action on the US Wall Street 30, but I overlay it with a higher time frame technical indicator like the 20-day and the 50-day moving average. So I'm able to do multi time frame analysis on a single chart instead of switching between the daily chart and the hourly chart. It saves us time. All right. So TradingView is able to actually allow us to do such we call it analysis. All right. So with that, as you could see, the price action of US Wall Street 30 has started to evolve within a minor descending channel, indicating to us that potentially right now we are in the midst of doing a multi-week kind of a corrective decline scenario within its major uptrend phase that is still intact. So with that, I will use a tighten key short-term pivotal resistance for today at 39,100. Why is it key? 39,100 confluence with the 20-day moving average, also confluence closely with the upper limit of this minor descending channel, and as well as the pullback resistance of that former expanding wedge support now turns into a resistance that I drew from the low of 14th of February, the dotted red line over here. Okay, also confluencing closely with 39,100 as well. So as long as 39,100 short-term pivotal support resistant hold, not support, resistant holds in any case of any bounce. So potentially right now we could potentially see a minor bounce coming into the picture. Why? Because the RSI has managed to exit from the oversold region on the hourly basis. So first resistance to watch will be at 38,660. I don't want to use this level here so tight as my short-term pivotal resistance level, because it's only confluence with one element, whereas the 39,100 short-term pivotal resistance confluences with multiple different technical elements pointing all at the same area, same level at 39,100. So as long as 39,100 short-term pivotal resistance doesn't surpass the upside, maintain that short-term bearish bias. So for sure, first support level to watch will be at this level here. Okay, yesterday's minor swing low, okay, at 38,330. a break below 38,330 exposes the next support area at 38,200/38,060, which is the lower limit of this minor descending channel, and as well as the congestion area over here as well from 15th of February, 14th of February, and 1st of February. Okay, we could see pretty much clear this level. Only hourly close above 39,100 invalidate this bearish bias to see a potential squeeze up to expose the next intermediate resistance 39,365. Above it, sees the risk of a retest of the current all-time high area at 39,990. Now, what's next for the Nasdaq 100? So Nasdaq 100 managed to help the 50-day moving average again before bouncing up slightly above the first support level that we highlighted, 17,840. So given yesterday's short reaction of the pullback resistance of that former minor bearish ascending wedge support level that has been taken down, and now it turns into a pullback resistance that has previously kept previous upside since last Friday, and yesterday it actually retest and shaped that severe negative reaction of it. So I'll be using 18,300 for sure as my short-term pivotal resistance for today, a Titan one for today. So as long as 18,300 short-term pivotal resistance is not surpassed to the upside, still maintain that short-term bearish bias on the Nasdaq 100. First support level to watch 17,840. A break below exposes the next near-term support level at 17,560, which is this congestion zone of 20th and 21st of February over here. Only hourly close above 18,300 will invalidate this short-term bearish bias to potentially see a retest of the current all-time high area at 18,470. A break above 18,470 exposes the next near-term resistance at 18,620. Okay, so net overall, we will still maintain that short-term bearish bias across the board for all the major US all the major stock indices that we cover, with the exception of the Hong Kong 33 or the Hang Seng Index, where we flip to a neutrality range bias for today. Now, FX market. So FX market, those who actually follow our daily dose of market is inside. We did highlight earlier before we went on our leave on our public holiday break yesterday at the euro dollar. On Monday and Tuesday, we maintained that potential bounce. So the bounce level has been met right below the 1.0890 resistance level before that negative reaction took shape yesterday. Pump. All right. So this euro dollar, right, if you look at from a technical perspective, since the low of 14th of February, it has been trading inside this potential symmetrical triangle range configuration. And right now, it hit the bottom of the symmetrical triangle range configuration. And with the RSI also attempting to actually exit from the extreme oversold condition that it was seen yesterday. So with that, right, we will now have that short-term bullish bias within a range configuration. So like I stress again, the euro dollar is trading within a range. So right now, since it's actually hit the bottom of this range, so right now we are looking for a oversold condition to take advantage of a potential bounce within right above the bottom of this symmetrical triangle range. So I'll be using 1.0725 short-term pivotal support level to have that potential a minor bounce, we call it scenario, to take shape. As long as 1.0725 short-term pivotal support holds, resistance level to watch will be the middle part of this range at 1.075 and 1.080. So what's 1.080? If you do the Fibo reaction or Fibo retracement of the steep downfall yesterday, it's close to the 50% Fibo retracement. All right. Okay. However, an hourly close below 1.0725 will kickstart a major, kind of a medium-term bearish breakdown scenario. Since it's broken down below the symmetrical triangle range configuration. The next support level to watch will be at 1.0695, followed by which is the swing low of 14th of February, followed by 1.0660. Okay, so what's 1.0660 is actually here, the swing low area of 8th of November and 10th of November last year. All right. Sterling dollar. Okay, so sterling dollar right now is actually floated down to the bottom of a range configuration as well. Okay, so if you look at the sterling dollar on an hourly basis, it seems to be trading in a sideways range since the low of 7 or 8 of December last year. All right. Okay, so this considered as this 8th of March here is like a failure breakout, then before re-entering back into that sideways range again. So since yesterday's sell-off, right, the previous day before we went on leave, we will actually have a neutrality stance on the sterling dollar. Since yesterday's sell off, it hit the bottom, it hit towards the lower limit of this call it rectangle range configuration, okay, or rectangle range configuration at 1.2540, the lower limit over here. So we'll be using 1.2540 as my short-term pivotal support level to actually look out for a potential minor bounce off from this rectangle range configuration support, which is at 1.2540. And so given the fact that the hourly RSI has just started to exit from after hitting a rather extreme oversold level condition yesterday. So with that, the two resistance to watch will be at 1.2575 and 1.2615 for that potential minor bounce scenario to play out. So 1.2615, if you do the Fibo retracement of yesterday's steep down move, is 50% retracement as well. Okay, only an hourly close below 1.2540 will indicate a bearish breakdown from the rectangle range configuration and invalidate that, for sure invalidate that minor bounce scenario, with the next support coming in at 1.2440 followed by 1.2380. Okay, over here. All right, this congestion area here. Then with that, let's take a look at the Aussie dollar. Okay, so the Aussie dollar is very similar as well. Yesterday or the day before yesterday, before we went on our one-day break, we did highlight the Aussie dollar to be bearish below the 66.50 level, and indeed the plunge took shape and hit the support zone of 65 figure level thereabout. Okay, so where we are right now is at the bottom of this symmetrical triangle range configuration again over here, that is in place since 14th of February this year. So at the bottom of the symmetrical range, and also the hourly RSI has managed to exit from just exited from a extremely oversold condition that was made yesterday. So with that exit from the oversold region and with the RSI, with the price action managed to help at this juncture at the lower limit of the symmetrical triangle range configuration. So we will flip to a bullish bias for a minor bounce scenario. Okay, so bear in mind, this is not a start of a medium-term uptrend. It's just a bounce within a symmetrical triangle range configuration of the Aussie dollar, since now at the lower limit of the range. 64.95 short-term pivotal support level. Resistance level to watch will be at 64.40/65.50 level. We also confluence with the 20-day, 50-day, and the 200-day moving average acting as a resistance at around 65.50. All right, only an hourly close below 64.95 will invalidate this minor bounce scenario to expose the next support level at 64.80 followed by 64.50 level. So 64.50 is in fact the minor swing low area of 14th of February. Then dollar yen. So dollar yen, given the fact that all the major FX pairs has started to shape very strong dollar strength yesterday, so it broke above the major resistance at 51.95. No signs of BOJ coming in to intervene the market, so we got to respect the price action and flip to a bullish bias instead on the dollar yen. Okay, so the dollar yen, using for sure 51. Okay, I don't want to put it so tight. If you have to look at the first support level, okay, the first support level will be this level over here. Okay, the meeting line between the two bullish candle, okay, these two bullish candle, the meeting line, okay, at 152.40, okay, roughly 152.38 or 0.40, okay, if you round up. Okay, so what we could see over here is that potentially there could be a bit of minor pullback, given that the RSI has now exit from the overbought region. Okay, just as if from the extreme overbought region, there could be a pullback, but as long as this pullback managed to hold at the 51.95 short-term pivotal support for today, we will flip to a bullish bias on the dollar yen. We got to respect the price action. Next resistance level to watch will be at 153.60 followed by 154.25, 154.60 level. Only an hourly close back below 151.95 will invalidate yesterday's bullish breakout, so that if it comes down below 151.95, so yesterday's price action will be kind of a failure bullish breakout, or a bear trap we call it, or a bull trap we call it, to see the price action retesting the 5th of April minor swing high at swing low area at 150.90, followed by the 50-day moving average acting as a support as well at 150.30. All right, so that's for the dollar. So now for gold, yes, even though gold yesterday managed to actually come down, but it managed to survive right exactly at the short term minor ascending channel support that I drew from the low of 27th of March. Okay, over here it managed to bounce out. So this will be kind of a first support level to watch for today at what 200327, but I don't want to use this support level too tight, so I'll still maintain yes the short-term pivotal support at 2300 level. So as long as any potential pullback managed to hold above the 2300 level, we will still maintain that short-term bullish out bias on spot gold XAU/USD. First resistance to watch will be 2370, followed by the upper limit of the minor ascending channel, which also confluence with the 2400 resistance, second resistance that we highlighted on Tuesday. Only an hourly close below 2300 will negate this short-term bullish bias to see a potential minor corrective decline extension to expose the next support level coming in at 2266, which is the minor swing low of 5th of April. A break below it exposes 2206 level. All right, then for West Texas Oil, lastly, so West Texas Oil, the price action has been rather bullish on a daily basis yesterday. What we could see yesterday, price bounce off this level here. Okay, so with that, right, if you could recall, on Tuesday we do have a bearish bias on the West Texas Oil to do a bit of a further minor corrective decline extension towards 83.20, which is close to the 20-day moving average. But given yesterday's strong bounce after the retest of the first support at 84.90, okay, it retested and it bounced off here, and this retest of the 84.90, it allows the RSI or causes the RSI to actually shape a bullish divergence instead, where price action shows similar low, okay, same low, but price action on the RSI show a higher low. So that's a bullish divergence, indicating to us that yesterday's downside momentum has started to ease off. So given the RSI has turned bullish, we will be less, the odds to actually shape that extension minor corrective decline has been reduced. So with that, we will flip back to a bullish bias on West Texas Oil. I don't want to use the word. I don't want to use 84.90 as my short-term pivotal support level. So I'll use this as a first support, using 83.20 as my short-term pivotal support level. So as long as 83.20 short-term pivotal support holds, flip to a bullish bias on West Texas Oil. First resistance to watch will be the psychological level 89 figure, followed by 90.70. Only an hourly close below 83.20 will invalidate or negate this bullish bias to see the continuation of the minor corrective decline sequence to expose the next support level at 80.80, then followed by the key medium term support at 79.25, which is also confluence with the rising 250-day moving average. All right, so that's pretty much sum up for the short-term technical outlook. So before we go, let's take a look at the calendar. What are the key events to look out for today? Okay, for the economic calendar, let me switch. All right. So for today, Thursday, okay, so with the China CPI inflation data has been out. So after that, yeah, we do have ECB monetary policy that is out at 8:15 p.m. Singapore time, and most important, we will have the, okay, where is the, sorry, give me a minute, let me sort the calendar again. I don't know what's going on. Okay, let me sort the calendar. Yeah, 8:15 p.m. Singapore time for ECB. So market is expecting no change at 4.5%, the key policy rate, but the focus will be more on 30 minutes later, 8:45 p.m., where the President Lagarde will start to address the press. So in the previous ECB meeting, she did stress or give a kind of a more or less solidified guidance that the first interest rate cut in Eurozone will come in June. All right. So, but given the fact that the US Federal Reserve interest rate cut expectation has been pushed down the calendar, like I shared with you at the start of my daily dose earlier today, where the first interest rate cut now has been pushed to September of instead of June. So will ECB follow the same expectation that is being priced in the US, or will ECB continue to remain firm in their, we call it monetary policy guidance? All right, so something to keep an eye and watch for at 8:45 p.m. Singapore time today. Then thereafter, we do have a pretty much quiet US session. Okay, so that should be actually a sum up for the key events to look out for today. So with that, have a great day ahead, and we shall speak again tomorrow. Thank you.